I think the impact of the U.S. tariffs is going to be greater on the U.S. economy than on the Chinese economy. We know that the Chinese economy is much less dependent on exports than it was a decade ago before the global financial crisis. Back then, net exports, which is the economics concept of the value of a country's exports minus its imports, so we don't count the imports twice, was about 9% of China's GDP back then. Now it's only 2%. So a pretty small part of the economy. The consumer part is much bigger. And also, only about 20% of China's total exports go to the United States. On the other hand, the U.S. is really dependent on a lot of goods that it imports from China. There aren't alternative sources right now. So we have to remember that tariffs are a tax which is going to be paid by American consumers and companies. That's a good question, and I don't think there's a straightforward answer because I think the Trump administration is divided. There are some people in the administration who are worried about China's rise and would like to decouple the U.S. economy from the Chinese economy. But it's probably not possible to do, given the role of global supply chains today, something that wasn't around a couple of decades ago. There are also, though, signs that there are people in the Trump administration who just want a better trading relationship between the United States and China. And President Trump so far has not talked about the broader long-term relationship between the two countries, just about getting a better deal. Well, let me start by saying that I don't think the Chinese economy is slowing that much right now. Everything in China looked at on a year-over-year basis has been gradually decelerating for a decade now. And what we're seeing today compared to last year is an economy which is pretty much as good as it was last year. Look at corporate earnings, for example. They're up about 17% off of a base of 21% last year. So I think the economy's doing quite well, which is why we haven't seen a stimulus so far. If the trade conflict with the U.S. has a bigger impact and results in a sharper slowdown, then the government will definitely step in with a stimulus. But I don't think it'll be the same kind of stimulus as they used 10 years ago. Less focused on infrastructure, more on the consumer, less on bank lending to finance it, more on direct fiscal spending. And the government's fiscal revenue growth is up about 10% this year, which is the fastest growth rate in 6 or 7 years, so they have the money. I think the best part of the Chinese economy, certainly from the perspective of an equity investor, is that China is the world's best consumer story. Inflation-adjusted retail sales growth of about 7%, and this is based on phenomenal income growth. Over the last decade, for example, real or inflation-adjusted income growth for average households in China is up 123%. Compared to a 9% growth rate in the United States. Households are not heavily into debt other than mortgages, which are really safe kind of mortgages that we used to do in the U.S. a couple of decades ago. So I think that consumer story, which is now the biggest and fastest growing part of the economy, is something that shouldn't be underestimated and should be pretty well insulated from trade disputes. Well, one way to look at that is to understand the contribution of China to global economic growth. So last year, the U.S. accounted for about 9% of global economic growth. China contributed 31% of global growth. Now, I'm not saying the average investor wants to have a 31% exposure, but you certainly want to be investing in some of that growth. And not enough American investors have exposure to what's really the most dynamic part of the world, China and the rest of the Asian region. So we are just encouraging people to take a closer look at that. And then you can decide whether you want to take a more conservative approach, for example, focus more on companies that pay dividends, or focus more on growth. Well, that's kind of an easy question because I work for Matthews Asia, which is the largest Asia-only active investor in North America, which means that we pick stocks for our clients. And the reason we take that approach is an index in Asia, especially in China, is a haphazard approach. While that might work in the United States as a more developed market, if you look at the index composition in China, it's disproportionately weighted towards state-owned enterprises, too light on private entrepreneurial listed companies and not heavy enough focus on the consumer and services part. And so that's where an active approach of picking the right stocks, if you've got people who are here all the time doing the on-the-ground due diligence, I think can be a better way for investors.